We're always hearing about these hot trading strategies, like trying to time the market, catching those quick wins. But what if the way we've traditionally been thinking about short-term trading is missing a key piece of the puzzle?
Yeah, I mean, there's always a new strategy popping up.
But this time, it might be more than just hype. We're diving into some research today that really challenges a fundamental assumption.
Oh, absolutely. This goes deeper. It's not just about a new indicator or a fancy algorithm. It really gets into how we think about risk and return, especially in the short term.
The idea that every stock has kind of the same expected return in the short run, well, that might be holding us back.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Right, and that's exactly where this new research comes in. They're calling it the short-term excess return strategy, or ESTER for short.
ESTER. So what's the basic idea behind this ESTER thing?
So imagine the classic short-term reversal strategy, right? You buy stocks that have recently gone down, hoping they'll bounce back. You sell stocks that have gone up, figuring they're due for a correction.
Yeah, buy low, sell high. The age-old advice. But what's the catch?
The catch is that it assumes all stocks have the same expected return. Like, if a stock drops 10% last week, it's automatically considered a bargain. But is it really?
I guess it depends on the stock, right? A solid, stable company dipping 10% might actually be a good deal. But a super risky company, maybe not so much.
Exactly, and that's what ESTER tries to account for. It goes beyond just recent price movements and factors in the specific characteristics of each stock.
So instead of just looking at price, it's looking at whether a stock did better or worse than we'd expect based on its fundamentals and stuff, right?
Precisely. It's about understanding the conditional expected return. That means the return we'd expect for a particular stock given its unique attributes at that particular time.
So if a stock is known for being volatile, a 10% swing might be par for the course. Not really a sign of mispricing, but for a stable blue-chip company, that same 10% drop might be a screaming buy signal.
Yeah, that's a good way to think about it. The key is to figure out what a stock's normal behavior should be, and then identify when it deviates from that.
Okay, so that makes sense conceptually. But how do they actually do that? How do you predict what a stock's normal return should be, especially in the short term?
That's where things get really interesting. They use machine learning. Specifically, they use these advanced algorithms that can sift through tons of data and find patterns that traditional models might miss.
Machine learning, huh? I keep hearing about how it's changing everything, so it's not just about plugging numbers into a formula. It's about letting the computer figure out its own patterns.
Exactly. They feed the machine learning models a ton of information about each stock. Things like profitability, valuation ratios, past performance, you name it. They used over 200 different factors.
Oh, wow. Over 200 factors. That's way more than your typical financial model.
Oh, yeah. This is about going deep. They wanted to capture as much information as possible to get a really precise estimate of what each stock should be doing. And they found that a combination of different machine learning models like gradient-boosted trees and neural networks gave the best predictions.
Sounds pretty high-tech. So these models churn through all that data and spit out an expected return for each stock, right? But how does that get us to ESTER and the actual trading strategy?
Right. So the short-term excess return, ESTER, it's calculated by comparing a stock's actual return over the past month to its expected return from the machine learning model.
Okay, so if the actual return is much lower than the predicted return, that would be a low ESTER.
Exactly. A low ESTER suggests the stock has underperformed. And that's where the trading signal comes in. They buy those low stocks, figuring they're undervalued and likely to bounce back.
And conversely, if a stock's actual return is way higher than predicted, it gets a high ESTER, signaling that it's overvalued and ripe for a sell-off.
You got it. So the strategy is basically buy low ESTER, sell high ESTER. Pretty straightforward in principle, but the complexity is all in those machine learning models that generate the expected returns.
Right, that's what makes it different from the traditional approach.
Yeah.
So what kind of results did they get with this fancy machine learning strategy?
The results are actually pretty amazing. From 1993 to 2022, the ESTER strategy generated an average monthly return of 1.773%.
Hold on, almost 1.8% per month, consistently. That's huge. How does that compare to the traditional short-term reversal strategy?
Well, the traditional approach only yielded about 0.291% per month over the same period, and that was statistically insignificant, meaning it basically just broke even.
Oh, wow. So the ESTER strategy is crushing it, more than 6 times the return. And did these results hold up even when they adjusted for risk, like market risk or the riskiness of individual stocks?
Yeah, they did a bunch of robustness checks, and the returns remained significant even after controlling for all sorts of risk factors. So it's not just about taking on more risk to get those higher returns.
That's really impressive. So it seems like this ESTER thing actually works, but I'm also curious about the why. Is it just about those underperforming stocks bouncing back, or is there something more to it?
That's a great question. And the researchers dug into that too. They actually found that a strategy based solely on the lagged conditional expected return, meaning you just buy the stocks the model predicts will do well and sell those it predicts will do poorly, that alone generated a significant return.
So the machine learning model, even without the ESTER part, was pretty good at predicting which stocks would go up or down.
Yeah, exactly. The predictive power of the model itself is a big part of the story, but, and this is crucial, the ESTER measure still added value on top of that. They found that even after accounting for the information in the lagged expected return, the ESTER signal still had significant predictive power.
So it's not just that the model is good at picking winners and losers. The ESTER is capturing something extra. Like maybe it's identifying those stocks that have become mispriced due to, I don't know, investor overreaction or something.
That's exactly what they think is going on. The research suggests that a big part of ESTER's success comes from identifying these short-term mispricings that are caused by investors overreacting to news or events.
Okay, so let me see if I've got this straight. We've got these machine learning models crunching tons of data, spitting out these really precise expected returns for each stock. Then we've got ESTER, which is basically telling us how much a stock's recent performance has deviated from that expectation. And the idea is that those deviations, those mispricings, are often caused by investors getting all emotional and overreacting. And that creates an opportunity for the ESTER strategy to profit as things eventually evened out.
You nailed it. That's the gist of it.
Wow. This is pretty mind-blowing stuff. It really challenges the way we think about short-term trading.
I think it opens up a lot of new possibilities. And it shows how powerful machine learning can be when applied to finance.
Totally. It makes you wonder what other hidden patterns or opportunities are lurking out there in the market, just waiting to be discovered by these advanced algorithms.
Well, that's what makes this field so exciting. There's always something new to learn and explore.
For sure. Well, this has been a fascinating deep dive into a really cutting-edge area of research. Thanks for walking us through it.
My pleasure.
And for you, the learner, we hope this deep dive has given you some food for thought and maybe even sparked some ideas about how you can incorporate these concepts into your own investment approach. Until next time, keep exploring, keep learning, and keep diving deep.